Crocs just plunged to its lowest level since 2022, dropping a massive 29% in a single day. Yet super investor Norbert Lou just started to buy this stock, and straight away he made it 17.4% of his US stock portfolio. So what does he see that the market is missing? Today we are going to go through our 7-step analysis process to understand what's really happening with this footwear giant. Why has the stock dropped so dramatically? Is this a temporary setback or a sign of deeper problems? And most importantly, is this crash creating an incredible buying opportunity? But before we dive into the analysis, let me quickly mention our sponsor for today's video, Forecaster.biz. We'll be using their website throughout the analysis to get the most accurate picture of Crocs' financial health. So let's go to our analysis library and choose Crocs. And looking at our company dashboard, we can see some impressive numbers for past performance. The 5-year total return is at a very nice 91%. But the 10-year total return shows an incredible 443.4% gain. That's phenomenal for any stock, let alone one in a mature footwear industry. Looking at our past results score on the dashboard, Crocs gets a solid 2.5 out of 3, which reflects this strong historical performance, and that's despite the recent crash. But let's understand what caused this dramatic drop. If we go to Forecaster and choose transcripts and then AI earnings call highlights, we get all the most important informations from the recent earnings call. But let's go all the way down here to conclusion. And we can read that while the company exhibited positive revenue growth, strong earnings per share and successful brand initiatives, it also faces considerable headwinds. The primary concern revolves around the uncertainty of global trade policies and potential tariffs, leading to a withdrawal of full-year guidance. And that is the key piece of information. Crocs shares plunged 29% in a single day after the company's earnings call when CEO Andrew Rees stated, "The current operating environment is uncertain and challenging to predict." And they are projecting a 9% to 11% decline in revenue for Q3. That piece of information triggered the sell-off. But let's look beyond the headlines and examine who owns this company. Individual insiders own 2.8% of the company, and that is a very meaningful amount, showing that the management has a lot of skin in the game. And we have 2 super investors currently owning shares of this company, including Norbert Lou, for whom it is a new position, and straight away it makes up almost 17.4% of his portfolio, so a lot of conviction here. Our investors score show 1.5 out of 3, so not bad, but could be much better. Looking at our financial health metrics on the dashboard, we can see some really impressive numbers. Return on invested capital comes in at a strong 24.3%, and we want to see this number higher than 10%, so that is excellent. We know that the management is doing a fantastic job generating returns on invested capital. Net profit margin is outstanding at 22.5%. This is significantly above most industry averages and shows Crocs has excellent pricing power and operational efficiency. For share buybacks, we see minus 34.5%, which is fantastic news. This means they've been aggressively buying back shares, reducing the share count and increasing the value of remaining shares. Looking at our share outstanding history graph, we can see the trend evolve over time. Now, let's examine the debt situation. The years to pay debt metric shows 2.3 years, which is just slightly above our preferred 2 years threshold, but still manageable. But when we look at net debt, the trend in the last years is not great. So let's go to Forecaster to get a closer look at this situation. So we go to Fundamentals, Raw Data and Balance Sheet. And down here we have all the most important numbers. Net debt in the last 3 years is going down, but in 2022 it got much bigger than before. And the reason for that was the Hey Dude acquisition. Also, the total debt is slowly going down, so the trend is actually positive. Now, when we look at cash and cash equivalents, we see that it is a pretty stable situation. So it doesn't look that bad when we consider these trends. Overall, our financial health score is 2.3 out of 3, reflecting strong operational metrics with some minor debt concerns. Moving to our growth metrics on the dashboard, revenue growth shows a solid 13.1% compound annual growth rate, and we like to see this above 10%, so that's a check. Free cash flow growth is incredibly impressive at 32.1%. This shows the company's excellent ability to convert revenue into actual cash. Earnings per share growth comes in at an exceptional 55.9%. This is partly driven by their aggressive share buyback program, but also reflects genuine business expansion. Looking at our revenue history graph, we can see the explosive growth trajectory, and our earnings per share history graph shows similarly impressive growth with some volatility but a clear upward trend. Our growth score is an impressive 2.7 out of 3, reflecting this strong growth across all key metrics. Looking at our dividend section on the dashboard, we can see that Crocs is not paying any dividends. This isn't necessarily bad for a growth company. Instead of paying dividends, Crocs is reinvesting profits back into the business and using aggressive share buybacks to return value to shareholders. But nevertheless, our dividend score is 0. Now for the most interesting part. Let's look at our valuation metrics. Our DCF analysis shows 3 scenarios. Low scenario, 5%, then 4% growth. Medium scenario, 7%, then 6%. And high scenario, 11% growth and then 8%. So these estimates are much smaller than the past growth of Crocs, but we want to be conservative. That is why these numbers are closer to the predicted growth of the industry, or in case of the high scenario, closer to the revenue growth, but not earnings per share or free cash flow growth, which are just out of this world. So the intrinsic value in the low scenario is $142, in the medium $167, and in the high one $216. Now, when we apply our 30% margin of safety, we get $99 in the low scenario, $117 in the medium one, and $151 in the most optimistic scenario. The current price is $80, and our average intrinsic value with margin of safety is $122. This shows a current upside potential of 53%. That is very encouraging. Our current valuation score is an impressive 3 out of 3, indicating the stock appears significantly undervalued. Now let's look at our overall scores from all 6 categories on the dashboard. Past results score 2.5, that is great. Investors score 1.5, okay. Financial health score 2.3, another very nice result. Growth score 2.7, that is a surprise and a very impressive result. Dividend score 0, that is obvious since we don't get any dividends from Crocs. And the current valuation score is 3. And this gives us an overall score of 2 points out of 3, a very nice result. So it seems that the market overreacted to some short-term problems. But to make sure we really understand this company, let's go to Forecaster and use its qualitative scorecard, which is basically a set of 10 questions that define the strength and moat of any company. And we can see that Crocs got 7 points out of 10. That is definitely a good result, but let's read the conclusion to get more information. Crocs Incorporated exhibits a durable competitive moat through proprietary materials and distribution, strong customer advocacy, and a proven track record of crisis management. While innovation spending and recurring revenue models lag behind, robust pricing power, consistent financial growth, and clear expansion avenues underscore a favorable outlook. Now, if you would like to analyze companies by yourself and explore all the tools that Forecaster has to offer, then I would really appreciate if you would use my affiliate link. Not only because you would be supporting the channel that way, but also by using the code BOLD10, you can get a 10% discount at the checkout. So it is a win-win situation. And thank you, Forecaster, for sponsoring this video. So the current challenges for Crocs appear to be temporary headwinds affecting a fundamentally strong business trading at an attractive valuation. This could explain why smart money like Norbert Lou has such strong conviction in this company while others panic sell. The dashboard clearly shows a company with strong fundamentals, excellent growth metrics, and trading at a significant discount to intrinsic value. But even though the numbers look strong, we cannot underestimate the psychology of the crowd. Markets can sometimes remain irrational for much longer than we are willing to hold our shares. If you found value in this analysis, then definitely check my video about PayPal, another company at a very interesting price. Thanks for watching and see you in the next one.